What is a VA 5/1 arm and how does it actually work? In today's video, I'm going to break down one of the most popular options available to VA borrowers. For those of you that don't know me, my name is Rick Elmendorf and I'm a loan officer and VA loan expert. I do hundreds of VA loans a year and have been ranked in the top 30 loan officers in the country for VA loan production for the last decade. And today, I really wanted to break down the VA 5/1 arm because the term ARM or adjustable rate mortgage has a bad name. And I wanted to just break all that down for you today. Now, there's a lot of criticism out there regarding ARMs. Again, ARM stands for adjustable rate mortgage. And the idea that anything can move has been considered risky. I mean, who wants an interest rate that can go up or down? Well, maybe down, but not up. But it may be true with other types of mortgages that it's risky, like a conventional ARM with its crazy initial adjustments and caps, not to mention its high margins. We'll get into that in a little bit. But the VA loan is different. It's built different, and that's exactly what I want to get into today. So by the end of this video, you're going to see that the VA 5/1 arm isn't just a safe mortgage vehicle. It's also one of the most affordable loan options available to a VA borrower in today's market. So how does it work? Mechanically, it's simple. You get a VA loan with a fixed rate for the first 5 years. After that, it becomes a 1-year adjustable rate mortgage. Now, here's the good news. The interest rate is locked for the first 5 years. It cannot move. So that much lower rate, and yes, it's much lower, is guaranteed for 5 full years. And that brings up the question, why is the rate lower in the first place? I mean, why do people choose an ARM? Let's think about it from the lender's perspective. They're not guaranteeing your rate for 30 years. They're only guaranteeing it for 5. So in exchange for that, they give you a lower rate. Typically, you'll find a VA 5/1 arm priced about 0.75% up to 1 full percent lower than the 30-year fixed. At least that's where it is today as of the shooting of this video. But I want to go ahead and break down the payment savings. I'm going to show you a comparison of a VA 5/1 arm at 4.99% versus a VA 30-year fixed at 5.75, both on a $500,000 loan. The monthly payment on the 5/1 arm at 4.99, principal and interest is $2,681.05 per month. The monthly payment for a 30-year fixed at 5.75 is $2,917.86. So we're just looking at pure monthly savings of $236.81 per month. This is an annual savings of $2,841.73. And if you add all that up and you look at the total guaranteed savings over 5 years, that totals $14,208.67. Not too shabby. If you look at one of the main reasons people are choosing the VA 5/1 arm over the fixed rate, well, it's just simply that you have guaranteed cash flow for the first 5 years. And to add to all of that, here are 2 reasons why I feel the VA 5/1 arm is a very safe loan. First thing are the caps. Every adjustable rate mortgage has an annual cap and a lifetime cap. Now, the VA 5/1 arm comes with a 1% annual cap. That's very low. Typically, it's a lot higher, 2% cap, or it can even adjust 5% on the adjustment year. But for the VA loan, that means that on its first adjustment in year 6, the maximum your rate could move up or down is only 1%. So, for example, if you locked in a 5% rate for the first 5 years, the absolute highest it could go to in year 6 is 6%, 1% higher than its start rate. Reason number 2 is the margin. When an adjustable rate mortgage adjusts, it's based on 2 things. You have an index value, which moves with the market, and a margin, which is fixed. It's like the bank's profit on the loan. Now, the margin on a VA 5/1 arm is incredibly low. Typically, you're adding only 1.75% to the index. Again, it's a very low margin. And when you add these 2 together, the index and the margin, it's what we call the fully adjusted rate or the fully indexed rate. This is the rate that would actually apply and calculate your payment in that subsequent year. Now, Now, remember I said about the margin being low. Because it's low, your index plus margin rate, so while it adjusts, is going to keep your loan affordable over time. Currently, the index plus margin fully indexed rate is much lower than the 30-year fixed rate of today. So here's my advice. If you're a VA borrower and the rates of the day feel too high, or you're not able to stretch comfortably for the house you really love, look at the VA 5/1 ARM in comparison. The VA 5/1 ARM will give you a much lower payment in comparison to the 30-year fix, and it may just provide the affordability you're looking for. If you have any questions, please don't forget to comment. And if you found this video helpful, please like, share, and subscribe. This is Rick, and I'll see you on the next video.